Every collapse looks different on the surface. Different charts, different headlines, different villains. But underneath, the same rules keep revealing themselves. Empires fell, currencies died, markets burned. And yet, the same financial principles kept working, silently, brutally, without mercy for those who ignored them. Most people believe crashes are unpredictable accidents. They are not. They are examinations. And history has been grading the same answers for centuries. If you understand what survives collapse, you stop fearing downturns and start recognizing them. Liquidity is not a technical term reserved for textbooks or trading desks. It is the difference between control and helplessness when systems begin to fail. Every major financial collapse in recorded history shares a common pattern that becomes obvious only in hindsight. Assets that looked powerful, profitable, and invincible during expansion suddenly become traps, while simple access to cash, credit, or immediately exchangeable value becomes the rarest and most decisive advantage. Wealth, in moments of stress, is no longer defined by net worth statements or theoretical valuations. It is defined by the ability to act while others are frozen. During periods of economic stability, liquidity is dismissed as inefficiency. Idle cash is described as lazy capital. Investors are encouraged to stay fully invested, to maximize exposure, to optimize returns. This logic dominates bull markets, where price discovery is smooth and confidence is abundant. But history repeatedly demonstrates that when confidence collapses, liquidity transforms from a drag on performance into the ultimate form of power. In crises, liquidity does not merely protect capital, it transfers capital from the unprepared to the prepared. In the early years of the Great Depression, businesses with strong balance sheets still failed because their assets were illiquid. Factories, land, inventory, and equity stakes could not be converted into cash fast enough to meet short-term obligations. Banks that appeared solvent on paper collapsed because depositors demanded liquidity, not reassurance. The inability to meet immediate claims destroyed institutions that, under normal conditions, would have survived. Liquidity was not a bonus, it was survival. This pattern repeated itself decades later during the global financial crisis. Financial institutions held vast quantities of assets rated as safe, diversified, and sophisticated. Yet when trust evaporated, markets for those assets ceased to function. Prices did not fall in an orderly manner. They vanished. What could not be sold instantly became worthless in practice, regardless of its theoretical value. The institutions that endured were not the most innovative or aggressive, but the ones that maintained access to funding, central bank liquidity lines, and short-term financing. Liquidity was the dividing line between collapse and continuity. Modern financial systems attempt to mask this reality through complexity. Central banks act as lenders of last resort, creating emergency liquidity facilities to prevent systemic failure. During recent crises, massive interventions by institutions such as the Federal Reserve, the European Central Bank, and the Bank of Japan have reinforced the illusion that liquidity will always be available when needed. Trillions in emergency funding programs, asset purchase schemes, and liquidity backstops have been deployed to stabilize markets. These measures have reduced visible panic, but they have not eliminated the underlying rule. Liquidity still determines who survives. Central banks merely decide who receives it first. Economic data from past crises shows a consistent asymmetry. Entities with immediate access to liquidity acquire distressed assets at fractions of their prior value, while those without are forced sellers regardless of long-term fundamentals. This dynamic is visible across sovereign debt crises, corporate bankruptcies, and household balance sheets. Liquidity is not neutral. It redistributes ownership. At the sovereign level, countries with reserve currencies or strong foreign exchange buffers maintain policy flexibility during downturns. They can finance deficits, stabilize currencies, and absorb shocks. Countries without liquidity buffers face capital flight, currency collapse, and austerity under pressure. The difference is not productivity or moral discipline, it is liquidity. The ability to meet obligations without panic defines sovereignty in crisis. Corporate finance tells the same story. Firms that rely heavily on rolling short-term debt appear efficient during expansions. Their cost of capital is low, their returns are optimized, and their leverage enhances earnings. Yet, when credit markets tighten, refinancing risk becomes existential. Even profitable firms can fail if liquidity dries up. This is why during every downturn, profitable companies with weak liquidity profiles collapse alongside unprofitable ones. Cash flow timing matters more than income statements when markets seize. From an investor perspective, liquidity determines optionality. Optionality is the capacity to make decisions when others cannot. In liquid conditions, investors choose between opportunities. In illiquid conditions, choices are made for them. Forced selling destroys long-term strategy. Liquidity preserves it. This is why the most successful investors in history consistently emphasize cash reserves during periods of uncertainty, despite criticism during expansions. Recent global events reinforce this principle. Supply chain disruptions, energy price shocks, and geopolitical tensions have exposed the fragility of leveraged systems. Companies and governments that entered periods of stress with ample liquidity adjusted, renegotiated, and adapted. Those that entered fully optimized for efficiency faced immediate strain. Efficiency maximizes performance under stable conditions. Liquidity maximizes survival under unstable ones. Macroeconomic statistics often obscure this reality by focusing on aggregate growth, employment, and market indices. These metrics describe averages, not outcomes. Crises are not democratic. They do not affect all participants equally. Liquidity determines position in the hierarchy of survival. Those with liquidity dictate terms. Those without accept them. The psychological dimension is equally important. Liquidity reduces fear. Fear accelerates collapse. When individuals, firms, or governments believe they can meet obligations, panic subsides. When doubt emerges, rational behavior disappears. Markets transition from valuation to liquidation. Liquidity acts as a stabilizer, not because it increases value, but because it preserves confidence long enough for value to matter again. History does not reward maximal optimization. It rewards resilience. Liquidity is the most portable form of resilience. It allows delay, negotiation, acquisition, and endurance. Every collapse strips systems down to their essentials, and in those moments, liquidity is revealed not as a conservative choice, but as the most aggressive strategic asset available. This is why liquidity survives every collapse. Technologies evolve, financial instruments change, markets expand and contract, but the hierarchy remains unchanged. Those who can move endure, those who cannot are consumed. Liquidity is not passive. It is power waiting for opportunity. Debt is often described as a tool, a neutral instrument that can be used wisely or abused recklessly. This framing is incomplete. Debt is not neutral. It is an amplifier. It magnifies existing trends, accelerates outcomes, and removes margin for error. In periods of growth, debt creates the illusion of brilliance. Returns appear higher, expansion seems effortless, and risk looks manageable. In periods of contraction, the same leverage exposes fragility with brutal speed. Every major financial collapse confirms the same rule. Debt does not cause cycles, but it determines how violent they become. Modern economies are built on leverage so deeply embedded that it is often invisible. Governments roll deficits as a matter of routine. Corporations refinance rather than repay. Households depend on credit to smooth consumption. Financial markets price assets under the assumption that refinancing will always be possible. As long as cash flows expand and interest rates remain low, this structure appears stable. The moment either condition breaks, debt reveals its true nature. It transforms from a growth accelerator into a survival constraint. Historically, periods of relative stability encourage the accumulation of leverage. Risk models are calibrated on recent calm. Defaults decline. Volatility compresses. This creates statistical justification for higher debt levels, which in turn push asset prices higher, reinforcing confidence. The system becomes self-validating until it encounters stress. When that stress arrives, debt does not merely increase losses, it changes behavior. Decision-making shifts from optimization to desperation. The Great Depression illustrated this dynamic with clarity. The 1920s were marked by expanding credit, margin debt, and speculative leverage across households and businesses. When asset prices fell, debt obligations did not adjust downward. Cash flows collapsed while liabilities remained fixed. The result was not a gradual correction, but a cascade of forced liquidations. Debt turned a market downturn into a systemic collapse. Those without leverage endured. Those with leverage vanished. This pattern reappeared during the global financial crisis. Mortgage-backed securities, structured credit products, and interbank lending networks were built on layers of leverage that assumed continuous liquidity. When housing prices stopped rising, the system did not simply reprice risk, it seized. Debt obligations chained institutions together so tightly that the failure of one threatened all. Emergency intervention by central banks prevented total collapse, but the lesson remained unchanged. Leverage multiplied fragility. In recent years, global debt levels have reached historical extremes. Sovereign, corporate, and household debt have all expanded simultaneously. This is not coincidence. It is the result of prolonged low interest rates and policy choices that favored credit expansion over structural reform. Debt substituted for productivity growth. Instead of increasing output efficiency, systems borrowed time. That time was converted into higher asset prices rather than sustainable income. Economic statistics reveal the asymmetry. During expansions, leverage increases faster than output. During contractions, output falls faster than debt can be reduced. This imbalance creates nonlinear outcomes. Small shocks produce outsized damage. What appears manageable under normal conditions becomes catastrophic under stress. Debt removes flexibility precisely when flexibility is most needed. At the sovereign level, debt amplifies geopolitical and monetary vulnerability. Countries with high debt burdens lose policy independence during crises. Fiscal responses are constrained by market confidence. Currency stability depends on external financing. Nations with lower leverage absorb shocks through reserves and credibility. The difference is not ideology or governance quality alone. It is balance sheet structure. Corporate behavior follows the same logic. Leverage enhances returns on equity during stable periods, rewarding executives and shareholders. This creates incentives to increase debt aggressively. When conditions reverse, the same leverage forces layoffs, asset sales, and bankruptcies. Entire industries contract, not because demand disappears permanently, but because balance sheets cannot survive temporary disruption. Debt transforms temporary stress into permanent damage. Central banks have attempted to manage this amplification effect through monetary intervention. By suppressing interest rates and providing liquidity, they delay the consequences of excessive leverage. Institutions such as the International Monetary Fund repeatedly warn about debt sustainability, while simultaneously supporting policies that extend leverage cycles. This contradiction is structural. Reducing debt would require accepting short-term pain, something modern systems are unwilling to tolerate. The result is a global economy where stability depends increasingly on continuous refinancing. Debt does not need to be repaid, it needs to be rolled. This distinction is critical. As long as refinancing is available, leverage appears harmless. When refinancing is questioned, even briefly, the system destabilizes. This is why interest rate expectations matter more than interest rate levels. Confidence in future access to credit sustains leverage. Doubt destroys it. From an investor perspective, debt creates asymmetric risk. Upside is capped by market competition and valuation limits. Downside is unbounded when leverage forces liquidation. This is why the most severe losses in financial history are not caused by poor assets, but by excessive leverage applied to ordinary ones. Debt magnifies error. It punishes timing. It eliminates patience. Psychologically, debt changes incentives. Borrowers become sensitive to short-term fluctuations. Long-term strategy gives way to immediate survival. This feedback loop accelerates downturns. As leveraged participants sell to meet obligations, prices fall further, triggering additional selling. Debt converts market corrections into cascades. Every collapse teaches the same lesson in different language. Leverage rewards confidence and punishes reality. It creates the appearance of control while quietly narrowing the range of possible outcomes. When systems are stable, debt feels intelligent. When systems fracture, debt reveals itself as the most unforgiving constraint in finance. Debt does not merely amplify outcomes at the moment of collapse. It reshapes the entire trajectory of recovery long after the panic subsides. Economies burdened by excessive leverage do not rebound quickly because recovery itself requires flexibility and debt removes it. This is why post-crisis periods are often defined not by renewal, but by stagnation. Growth resumes on paper, yet living standards lag, productivity weakens, and inequality deepens. Debt survives the collapse and becomes the architecture of the future. After every major downturn, the same pattern emerges. Private debt migrates to public balance sheets. Losses are socialized. Governments absorb liabilities to stabilize systems, converting corporate and household leverage into sovereign obligations. This process prevents immediate collapse but embeds fragility at a higher level. What was once a private risk becomes a systemic one. The center of gravity shifts, but leverage remains. This dynamic was visible after the global financial crisis, when governments across developed economies expanded deficits dramatically. Balance sheets of central banks grew to unprecedented sizes. Institutions such as the Bank for International Settlements began openly discussing the limits of debt-driven stability. Yet policy responses continued to rely on the same mechanism: more borrowing to offset the consequences of past borrowing. Debt was treated as both the problem and the solution. In theory, debt can be reduced through growth, inflation, restructuring, or default. In practice, modern systems resist all four. Growth is constrained by demographics and productivity trends. Inflation is politically sensitive and uneven in its effects. Restructuring threatens financial stability. Default undermines trust. As a result, debt persists. It is rolled forward, extended, and reclassified, but rarely eliminated. Time is substituted for resolution. The corporate sector illustrates this clearly. In the aftermath of crises, weak firms are often kept alive through refinancing and low interest rates. These so-called zombie companies generate enough cash flow to service debt, but not enough to invest or innovate. They occupy economic space without contributing to dynamism. Debt allows them to survive, but at the cost of overall productivity. The economy appears stable, yet growth potential erodes quietly. Households experience a similar constraint. High debt levels reduce consumption flexibility. Income growth is diverted towards servicing obligations rather than building savings or investing in education and mobility. This suppresses long-term demand and increases vulnerability to future shocks. Debt stabilizes the present by mortgaging the future. At the geopolitical level, debt becomes a strategic vulnerability. Nations with high leverage depend on favorable global financial conditions. Rising interest rates, capital outflows, or currency depreciation can quickly destabilize domestic systems. Policy choices become reactive rather than strategic. Sovereignty narrows as dependence on external financing grows. Debt transforms economic decisions into confidence management exercises. Financial markets reflect this reality through heightened sensitivity to central bank signals. Asset prices respond not to underlying fundamentals alone, but to expectations about credit conditions. When leverage is high, small changes in rates or liquidity expectations produce outsized market reactions. Volatility increases not because fundamentals worsen dramatically, but because debt compresses tolerance for uncertainty. This environment creates a paradox. Stability becomes fragile precisely because systems are engineered to avoid pain. By preventing short-term corrections, debt accumulation increases the magnitude of eventual adjustment. Small failures are suppressed until they combine into systemic threats. Debt smooths cycles temporarily while making them more destructive over time. For investors and decision makers, this leads to a critical insight. Risk is not defined by volatility alone. It is defined by leverage exposure to uncertainty. Assets financed conservatively can withstand prolonged stress. Assets financed aggressively require constant favorable conditions. The difference determines survival. Every collapse ultimately reveals that debt is not free. It demands continuity. It assumes predictability. When reality deviates, debt enforces its terms without negotiation. Systems that rely on leverage trade resilience for speed. They grow faster, appear stronger, and impress observers until conditions change. This is why debt has survived every collapse, not as a solution, but as a recurring accelerant. It does not disappear because it aligns with human incentives. It promises more today in exchange for less tomorrow. It rewards optimism and punishes caution. History shows that optimism dominates until it cannot. In the long arc of economic cycles, debt is neither villain nor hero. It is a force multiplier. It makes good systems look exceptional and bad systems look functional. When stress arrives, it removes the illusion. What remains is the underlying structure, exposed and uncompromising. Every generation rediscovers this principle in its own language. Leverage feels manageable until it is not. Stability feels permanent until it fractures. Debt amplifies everything, including denial. And when denial finally breaks, debt ensures that the consequences arrive faster, deeper, and with far less room to escape. Value is not what markets quote. It is what remains when markets stop functioning. Every financial collapse exposes the same hidden fracture that is easy to ignore during expansion. the separation between nominal value and real value. In stable times, prices dominate perception. Screens flash numbers, portfolios update in real time, and wealth appears measurable, precise, and permanent. In crises, that precision dissolves. What mattered yesterday no longer matters today. Liquidity vanishes, buyers disappear, and price becomes a suggestion rather than a fact. At that moment, markets begin to rediscover an ancient truth. Value exists independently of price. Nominal value is a social agreement. It depends on trust, participation, and continuity. It assumes that someone else will be willing and able to transact tomorrow under similar rules as today. Real value does not require agreement. It requires usefulness, scarcity, or endurance. When systems are stressed, nominal claims compete for survival, while real value stands still. This divergence explains why collapses do not destroy everything equally. They strip illusions first. Throughout history, monetary systems have failed, while value persisted. Currencies were debased, reissued, redenominated, or abandoned entirely. Yet land continued to produce, energy continued to power societies, and skills continued to generate income. Nominal wealth disappeared. Real value did not. The destruction occurred not in productive capacity, but in claims layered on top of it. Modern finance attempts to obscure this distinction through abstraction. Financial instruments represent ownership, exposure, or entitlement to future cash flows. Under normal conditions, these representations trade smoothly and appear interchangeable with the underlying value. During crises, the link breaks. Contracts remain valid on paper, but enforcement, liquidity, and settlement become uncertain. Nominal claims multiply faster than real capacity can support. This dynamic was evident during every major financial shock. Equity markets collapse not because companies instantly lose all productive ability, but because the price of claims adjusts violently to uncertainty. Bond markets freeze not because borrowers immediately become insolvent, but because confidence in repayment timing erodes. Real value remains unevenly affected, but nominal value resets brutally. Inflation accelerates this separation. When monetary expansion outpaces real output, nominal prices rise without a corresponding increase in real wealth. Assets appear to appreciate, but purchasing power stagnates or declines. This creates the illusion of prosperity while eroding substance. In such environments, holding nominal claims feels profitable until inflation forces a reckoning. Real value asserts itself slowly, then suddenly. Recent global developments illustrate this clearly. Massive fiscal expansion and monetary accommodation increased nominal asset values across markets. Equity indices reached record levels, real estate prices surged, and balance sheets expanded. Yet productivity growth remained modest. Real wages lagged asset inflation. The gap between price and value widened. This imbalance is not sustainable indefinitely. History suggests that when adjustment arrives, it favors reality. Commodities provide a useful lens. During periods of monetary stress, tangible inputs such as energy, metals, and agricultural goods often outperform financial assets. This is not because they are immune to cycles, but because their value is anchored in physical necessity. Nominal contracts tied to these goods may fluctuate, but the underlying demand persists. Real value reasserts itself through function. Gold occupies a unique position in this framework. It produces no cash flow, yet survives every monetary regime. Its value is not derived from productivity, but from endurance and universal recognition. During periods of currency instability, gold does not become more useful. It becomes more honest. It reflects the erosion of nominal trust rather than the creation of new wealth. This is why central banks, including institutions such as the People's Bank of China, continue to accumulate gold as a reserve asset. It is not an investment. It is insurance against nominal failure. Real estate demonstrates the same principle with more complexity. Property derives value from location, utility, and scarcity. During credit expansions, prices reflect leverage and speculation as much as fundamentals. During contractions, nominal prices adjust downward, but utility remains. Shelter does not disappear when prices fall. What changes is who controls it. Debt determines ownership transitions, not value itself. Labor is another overlooked example. Skills retain value even when wages fluctuate. In collapses, nominal compensation may decline, but essential capabilities remain valuable. Systems cannot function without them. This is why crises redistribute income and ownership rather than erase value entirely. Nominal structures collapse, real functions persist. The danger arises when investors confuse price stability with value stability. Long periods without major disruption encourage the belief that markets accurately reflect underlying worth. Risk models extrapolate calm. Correlations appear stable. Leverage builds on the assumption that price equals value. When stress emerges, these assumptions unravel simultaneously. Nominal valuations collapse faster than real capacity deteriorates, creating chaos for those positioned solely on price signals. Financial news often frames collapses as destruction of wealth. This language is misleading. What collapses is agreement, not reality. Wealth defined purely in nominal terms evaporates because it was contingent. Real value, defined by use, scarcity, and durability, endures, though ownership changes hands. This distinction explains why collapses are followed by consolidation rather than annihilation. Assets move from weak balance sheets to strong ones. Claims are written down, prices reset, value concentrates. The system sheds excess layers of nominal promises until what remains aligns with reality. Understanding this separation is essential for survival. Investors who anchor decisions to nominal performance alone are exposed to regime change. Those who understand value independent of price retain orientation when signals fail. This is not ideology. It is observation repeated across centuries. When systems fracture, markets stop asking what something is worth and start asking what it is. The answer determines survival. When nominal value collapses, the adjustment process is not instantaneous or clean. It unfolds through phases of denial, distortion, and redistribution. Markets attempt to preserve the old pricing structure, even as underlying assumptions fail. Liquidity injections, regulatory forbearance, and narrative management delay recognition. But these measures do not restore value. They only postpone its separation from price. Eventually, reality asserts itself, and when it does, the repricing is abrupt. This is why collapses feel nonlinear. For long periods, prices appear resilient, despite deteriorating fundamentals. Then, within a narrow window, confidence breaks and nominal valuations compress violently. This pattern is often misinterpreted as panic or irrationality. In truth, it is delayed rationality. Markets reconcile accumulated discrepancies all at once because gradual adjustment was politically, psychologically, or institutionally impossible. Economic statistics during these transitions often appear contradictory. Gross domestic product may stabilize, employment data may lag, and corporate earnings may show partial recovery, while asset prices continue to fall. This confuses observers who expect alignment between data and markets. The explanation lies in the difference between flow and stock. Economic activity measures flows. Asset prices reflect stocks of accumulated claims. When those claims exceed real capacity, adjustment targets valuation first, not production. Inflation further complicates this process. Nominal prices may rise even as real value declines. This creates the illusion that assets are recovering when, in purchasing power terms, they are not. Savers feel poorer despite higher account balances. This silent erosion is often politically preferable to explicit collapse. It allows nominal stability to coexist with real loss. Over time, however, inflation accelerates the separation by revealing which assets preserve value and which merely absorb currency expansion. Global capital flows respond accordingly. During periods of uncertainty, capital migrates toward assets perceived as stores of value rather than generators of yield. This explains why, during systemic stress, yield-seeking behavior reverses. Investors abandon complex structures in favor of simplicity. Cash, short-duration instruments, hard assets, and essential infrastructure attract demand not because they promise growth, but because they promise continuity. This behavior is observable at the institutional level. Sovereign wealth funds, pension systems, and central banks adjust reserve composition when confidence in nominal systems weakens. Accumulation of tangible reserves increases. Duration shortens. Counterparty risk becomes a primary concern. Institutions such as the World Gold Council document these shifts, not as speculative trends, but as strategic responses to uncertainty. The objective is not return maximization, but preservation of purchasing power. Corporate strategy reflects the same logic. Firms reduce capital expenditure, delay expansion, and focus on cash flow resilience. Mergers and acquisitions concentrate assets under stronger balance sheets. Distressed sales transfer ownership without destroying productive capacity. Nominal equity values fall, But factories, data centers, energy assets, and logistics networks continue to operate. Value migrates, it does not disappear. At the household level, the consequences are more visceral. Nominal wages may rise, yet living standards decline. Asset owners feel volatility acutely, while non-asset holders experience erosion through higher costs. This asymmetry fuels social tension and political intervention. Policy responses often target symptoms rather than structure, reinforcing nominal distortions while real constraints tighten. Over extended periods, repeated reliance on nominal stabilization erodes trust. Participants learn that price signals are conditional. Risk premiums increase. Long-term planning shortens. Economic actors prioritize flexibility over optimization. This behavioral shift reduces efficiency but increases resilience. Systems become less productive but harder to destabilize. This trade-off is rarely acknowledged, yet it defines post-collapse landscapes. The final stage of separation occurs when new nominal anchors emerge. Currencies are redefined. Regulatory frameworks reset. Valuation benchmarks adjust. What was once considered conservative may now appear reckless, and vice versa. This recalibration is not moral or ideological. It is adaptive. Systems align incentives with what survived. Throughout this process, one lesson becomes unavoidable. Price is temporary. Value is persistent. The two can diverge for long periods, but they cannot remain disconnected indefinitely. When reconnection occurs, it favors what is useful, scarce, and durable. Every collapse rewrites the same conclusion in different terms. Nominal structures expand faster than reality can sustain. Eventually, the excess is removed. Those who mistake price for value experience shock. Those who understand the distinction experience transition. When markets stop functioning smoothly, clarity returns in its harshest form. What remains is not what was most admired, but what was most necessary. Real value separates, survives, and quietly waits for the next cycle to begin. Diversification is one of the most misunderstood concepts in finance because it is marketed as protection from loss, when in reality it is protection from annihilation. In stable markets, diversification feels unnecessary. Correlations appear low, trends are persistent, and concentration is rewarded. Investors who focus capital into a narrow set of assets outperform and are celebrated as visionary. This period shapes expectations. Diversification becomes associated with mediocrity rather than survival. History, however, is unforgiving to this illusion. Every major collapse reveals the same uncomfortable truth. When stress becomes systemic, correlations converge. Assets that appeared unrelated begin to move together. Markets do not fail independently, they fail collectively. Diversification does not stop drawdowns because drawdowns are the mechanism through which systems reset. What diversification does is prevent permanent loss of capital. It preserves participation in the aftermath. This distinction is critical. Losses can be recovered, ruin cannot. Diversification is not designed to eliminate volatility. It is designed to eliminate extinction. During collapses, investors who misunderstood this difference often discover too late that their portfolios were diversified only in name. Exposure to multiple assets within the same risk regime is not diversification. It is redundancy. Historical data confirms this repeatedly. Equity markets across regions fall together during global crises. Corporate bonds correlate with equities when credit tightens. Real estate declines alongside leveraged assets when financing dries up. The apparent safety of spreading capital across similar instruments disappears when the underlying driver is the same: liquidity and confidence. When both evaporate, diversification by label fails. True diversification operates across fundamentally different sources of risk. It acknowledges that during stress, the primary threat is not price fluctuation, but forced liquidation. Assets fail investors not because they decline, but because they require action at the worst possible moment. Diversification reduces the probability that all holdings demand the same response simultaneously. The Great Depression provides an early illustration. Investors heavily concentrated in equities experienced catastrophic losses and were unable to recover for decades. Those with exposure to cash, government securities, and productive land endured drawdowns but retained optionality. Their portfolios did not outperform during the boom. They survived the bust. The same pattern emerged during the global financial crisis. Portfolios optimized for yield collapsed when credit markets froze. Structured products that appeared diversified across thousands of underlying exposures failed together because they shared the same dependency on leverage and refinancing. Investors who held simpler, less correlated assets absorbed losses but remained solvent. Diversification did not spare them pain. It spared them elimination. Modern portfolio theory often fails to communicate this reality honestly. Mathematical models treat risk as volatility and assume stable correlations. These assumptions collapse precisely when diversification matters most. During crises, historical correlations are irrelevant. What matters is functional independence. Does this asset rely on the same system to operate? If the answer is yes, it is not a diversifier, it is a multiplier. Recent global events have reinforced this lesson. Supply chain disruptions, energy shocks, and geopolitical fragmentation expose the fragility of globally synchronized portfolios. Assets tied to the same growth narrative declined together. Investors learned again that diversification across markets without diversification across drivers is insufficient. Institutional behavior reflects this understanding more clearly than retail narratives suggest. Large endowments, pension funds, and sovereign entities diversify not to maximize returns, but to avoid single-point failure. Their portfolios often include assets that underperform during long expansions. These allocations attract criticism until crisis arrives. Then they reveal their purpose. Economic statistics support this approach. Over long horizons, diversified portfolios exhibit lower terminal risk, even if interim performance lags concentrated strategies. Survivorship bias distorts perception. We celebrate concentrated winners and ignore concentrated failures, because failure removes visibility. Diversification keeps participants in the sample. At the macro level, diversification applies to nations as well. Economies reliant on a narrow set of exports or funding sources experience deeper contractions during shocks. Those with diversified production bases and trade relationships adjust more gradually. The same principle governs systems at every scale. Diversification is often dismissed because it lacks narrative appeal. It does not promise extraordinary gains. It promises continuity. In financial storytelling, continuity is boring. In financial history, it is decisive. The psychological challenge lies in accepting losses without panic. Diversification ensures that during crises, some assets decline less than others, but none are immune. This can feel like failure to investors expecting protection from pain. In reality, it is the mechanism that prevents irreversible outcomes. The goal shifts from winning to remaining. Understanding this reframes expectations. A diversified portfolio is not designed to look intelligent during bubbles. It is designed to remain functional during collapses. Its success is measured not by peak performance, but by post-crisis positioning. Every collapse eventually reaches a point where capital concentrates. Assets transfer from those forced to sell to those able to wait. Diversification determines who belongs to which group. It decides whether an investor participates in recovery or becomes a historical footnote. This is why diversification survives every collapse, not because it avoids loss, but because it avoids disappearance. The aftermath of a collapse exposes the final function of diversification with brutal clarity. Recovery is not evenly distributed. It is selective. Capital does not return to where it once was out of nostalgia or fairness. It flows toward balance sheets that remained intact and toward actors who retained flexibility. Diversification determines who is able to receive that flow. Those who survived, with capital preserved, become liquidity providers in a world starved for it. Those who did not are spectators to their own displacement. This process explains why diversified portfolios often appear conservative before crises and dominant after them. They retain the capacity to rebalance when prices detach from fundamentals. They can acquire assets at distressed valuations, not because they predicted the collapse, but because they were not destroyed by it. Diversification creates asymmetry and optionality. It does not predict outcomes. It prepares for them. Market history is filled with examples where concentrated strategies produced extraordinary paper gains, only to end in permanent impairment. These strategies are celebrated during expansion because performance is visible and linear. Their failures are less discussed because they remove participants from the conversation. Diversification lacks glamour precisely because it remains present when narratives shift. Its advantage is not spectacle. it is endurance. In practical terms, diversification operates across time as much as across assets. Maturity structures, cash flow timing, and liquidity profiles matter as much as sector allocation. Assets that perform well at different points in the cycle create internal balance. When one source of return disappears, another remains active. This temporal diversification reduces the probability that all components demand attention simultaneously. Crises reveal that diversification is not static. It must evolve as systems change. Assets that once provided independence may become correlated as markets integrate. Financial innovation can reduce visible risk while increasing hidden coupling. True diversification requires continuous reassessment of dependencies. What matters is not the asset label, but the mechanism through which it generates value. This is why institutional investors emphasize scenario analysis rather than historical optimization. They ask what fails together, not what performed differently in the past. They assume that future crises will not mirror previous ones in form, but will replicate them in structure. Stress exposes interconnections that normal conditions conceal. Recent market behavior reinforces this view. During periods of tightening financial conditions, assets tied to leverage underperform together, regardless of geography or sector. Meanwhile, assets with independent drivers exhibit relative resilience. This pattern is not accidental. It reflects the collapse of a shared assumption: abundant liquidity. When that assumption fails, diversification by leverage fails with it. There is also a moral hazard embedded in misunderstanding diversification. Investors who believe it protects against loss may take excessive risk elsewhere, assuming insulation. When reality contradicts this belief, disappointment turns into panic. Proper diversification is psychologically demanding. It requires accepting underperformance during booms and losses during busts, without abandoning structure. Those unable to tolerate this discipline undermine the very protection they seek. At the policy level, diversification manifests as redundancy. Systems designed with multiple safeguards appear inefficient under normal conditions. During stress, they prevent cascading failure. Financial regulation often oscillates between these extremes, loosening standards during calm and tightening after collapse. The same cycle appears in portfolio construction. Memory fades, concentration returns. Diversification is rediscovered. The ultimate test of diversification is not whether it prevents drawdowns, but whether it preserves agency. Agency is the ability to choose rather than react. In a crisis, choice becomes scarce. Diversified portfolios retain it longer. They can wait, negotiate, and reposition. Concentrated portfolios lose it quickly. They respond under pressure, often at unfavorable prices. This distinction explains why long-lived capital tends to be diversified capital. Families, institutions, and nations that endure do so not through brilliance alone, but through structural humility. They assume error. They assume surprise. Diversification is the institutionalization of that assumption. When the next cycle unfolds, the same criticisms will reappear. Diversification will be described as inefficient. Concentration will be praised as conviction. Returns will favor those who took bold positions. And once again, when conditions reverse, diversification will quietly determine who remains. Its lesson is simple but uncomfortable. You cannot diversify away loss. You can only diversify away extinction. Those who understand this survive long enough to benefit from the next expansion. Those who do not contribute to the statistics that make diversification appear unnecessary. Every collapse ends with the same accounting. Some capital disappears, some capital transfers, and some capital endures. Diversification decides which category you belong to. Markets do not move as collections of independent, rational agents. They move as crowds, responding to incentives, narratives, and fear. Every financial collapse exposes this reality with precision. While models assume optimization, history records imitation. The crowd does not discover value early. It reacts late. This is not a flaw of intelligence. It is a structural feature of human behavior amplified by markets. During expansions, participation grows gradually. Early adopters act under uncertainty and are dismissed as lucky or reckless. As prices rise, confidence follows. Media coverage increases, performance attracts attention. Eventually, skepticism disappears and caution is reframed as ignorance. The crowd enters not because value is increased, but because consensus has formed. By the time the majority participates, upside is largely exhausted. What remains is vulnerability. This pattern is visible across centuries and asset classes. Equity manias, housing booms, commodity supercycles, and speculative innovations all follow the same trajectory. Early stages are quiet and fragile. Late stages are loud and crowded. Volume peaks near tops. Risk premiums compress as perceived certainty rises. The crowd mistakes familiarity for safety. Behavioral finance attempts to explain this through biases such as herding, confirmation bias, and loss aversion. These explanations are accurate but incomplete. The deeper driver is incentive alignment. Professional managers are rewarded for relative performance, not absolute outcomes. Underperforming peers during a boom carries immediate career risk. Avoiding losses during a bust does not. This asymmetry forces conformity. The crowd is not irrational. It is adaptive within its constraints. Financial media reinforces this dynamic. Narratives simplify complexity and reward continuity. Stories that justify existing trends gain traction. Contrarian perspectives are marginalized until reversal is obvious. By the time caution becomes mainstream, prices have already adjusted. Information does not lead markets, it follows them. Economic data plays a similar role. Indicators are backward-looking by construction. Employment, earnings, and growth statistics confirm trends after they occur. Policymakers and investors relying on these signals respond late. This delay amplifies cycles. The crowd acts on confirmation rather than anticipation. The consequence is predictable. Buying pressure concentrates near peaks. Selling pressure concentrates near troughs. Volatility increases as decisions cluster. Liquidity appears abundant when it is least needed and disappears when it is essential. The crowd does not create crashes alone, it accelerates them. Historical episodes illustrate this relentlessly. During equity bubbles, retail participation surges late. During credit expansions, lending standards loosen most aggressively near cycle highs. During housing booms, speculative demand peaks when affordability collapses. These are not coincidences. They are signals of saturation. When conditions reverse, the same mechanisms operate in reverse. Early sellers are criticized as pessimists. Initial declines are dismissed as corrections. Confidence persists longer than fundamentals justify. Then, suddenly, narratives flip. What was considered temporary becomes permanent. Selling accelerates, not because information worsens dramatically, but because tolerance for uncertainty collapses. At this stage, the crowd becomes a forced participant. Margin calls, redemptions, and policy shifts compress decision timelines. Selling is no longer a choice, it is an obligation. Prices overshoot not because value disappears, but because liquidity is demanded simultaneously. The crowd exits at the worst possible moment. This behavior is not limited to retail investors. Institutions exhibit the same pattern under different constraints. Portfolio mandates, risk limits, and regulatory thresholds enforce mechanical responses. When volatility rises, exposure is reduced regardless of valuation. When correlations spike, diversification fails temporarily. The crowd is institutionalized. Recent market episodes reaffirm this structure. Rapid repricing events occur despite abundant information and advanced analytics. Speed does not prevent herding, it accelerates it. Algorithms replicate human behavior at scale. They respond to the same signals simultaneously, compressing reactions into narrower windows. The crowd becomes faster, not wiser. The psychological cost of deviating from consensus remains high. Acting early feels lonely. Acting late feels safe. Markets reward comfort temporarily and punish it eventually. This is why disciplined contrarian behavior is rare and unevenly distributed. It requires not superior intelligence, but superior tolerance for isolation. Understanding this principle reframes risk management. The greatest danger is not being wrong alone. It is being wrong with everyone else. Crowded trades fail violently because exits are narrow. Uncrowded positions fail slowly or recover. The crowd creates fragility by concentrating exposure. This is why market tops feel stable and market bottoms feel chaotic. Stability emerges from agreement, not resilience. Chaos emerges when agreement breaks. By the time disorder is visible, repositioning is costly. The crowd always arrives at the moment when flexibility has vanished. The lesson is not to oppose consensus reflexively. It is to recognize timing asymmetry. Consensus is useful early and dangerous late. It signals acceptance, not opportunity. When participation becomes universal, optionality disappears. Every collapse confirms the same uncomfortable truth. The crowd does not lose because it lacks information. It loses because it waits for certainty. Markets reward anticipation and punish confirmation. Those who require validation enter when risk is highest and exit when opportunity is greatest. This is not a failure of markets. It is their defining feature. The crowd provides liquidity, momentum, and stability during expansion. It provides volatility, redistribution, and reset during contraction. Understanding where the crowd stands in the cycle is not predictive in a precise sense. It is protective. The crowd is always late because lateness is embedded in how collective confidence forms. By the time agreement exists, adjustment is already underway. Those who understand this do not try to outrun the crowd. They avoid standing with it when it begins to move. The cycle does not change, only the symbols do. The aftermath of crowd behavior is not merely loss, it is redistribution. Markets do not destroy wealth indiscriminately. They transfer it from those who act under pressure to those who retain autonomy. The crowd, by definition, forfeits autonomy. Its decisions are synchronized, reactive, and constrained. When exits narrow, the crowd pays the price of immediacy. This redistribution process explains why post-collapse narratives often feel unjust. Outcomes appear disconnected from effort, intelligence, or intent. Participants who followed widely accepted logic suffer alongside those who acted recklessly. Meanwhile, actors who appeared cautious or inactive emerge with disproportionate influence. This is not moral judgment, it is structural consequence. Markets reward timing and positioning, not consensus. After every major downturn, surveys reveal the same sentiment. Confidence collapses near lows, participation declines, risk tolerance evaporates. The crowd withdraws precisely when long-term opportunity expands. This inversion is not accidental. It is psychological exhaustion. Loss reduces the capacity to imagine recovery. Safety becomes the priority. Ironically, this collective retreat stabilizes prices by removing sellers, allowing recovery to begin quietly. Recovery phases are therefore rarely accompanied by optimism. Early rebounds feel fragile, unconvincing, and suspicious. Volumes are low, news remains negative, analysts warn of false dawns, the crowd remains absent. This is the environment where value accumulates, not where it is celebrated. By the time optimism returns, prices have already adjusted upward. The crowd re-enters after validation, repeating the cycle. This dynamic reveals a crucial asymmetry. The crowd defines trends, but it does not define turning points. Turning points occur when participation is minimal, not maximal. Tops require agreement, bottoms require exhaustion. This is why sentiment indicators, fund flows, and positioning data often matter more than headlines. They reveal crowd exposure, not narrative tone. Institutional behavior reinforces this pattern. Risk models are recalibrated after losses, not before. Constraints tighten following volatility, not preceding it. This leads to pro-cyclical behavior. Institutions reduce exposure after declines and increase it after stability returns. This is rational within mandate structures, but destabilizing at the system level. The crowd becomes a mechanism of delayed adjustment. Technology has not altered this structure, it has intensified it. Real-time data, social platforms, and algorithmic execution compress decision cycles. Signals propagate instantly, reactions synchronize. What once unfolded over months now unfolds over days or hours. Speed does not eliminate herding, it magnifies it. The crowd becomes more efficient at acting together, not at acting wisely. This has implications beyond finance. Political cycles, policy responses, and regulatory changes follow similar dynamics. Pressure builds gradually, then releases abruptly. Decisions made under collective stress tend to overshoot. Stability is restored through excess rather than balance. The crowd demands action when fear peaks, not when prudence would suggest it. Understanding crowd behavior does not grant immunity from loss. Even disciplined actors experience drawdowns. The advantage lies in avoiding forced decisions. Freedom of action is the rarest asset during crises. Those who preserve it can act incrementally rather than reactively. They can wait for conditions rather than chase them. This is why patience is often mischaracterized as passivity. In reality, patience is an active stance. It is the refusal to outsource decision-making to consensus. It accepts uncertainty without demanding immediate resolution. Most participants find this intolerable. They seek reassurance through alignment. The crowd provides comfort at the cost of timing. The final irony is that the crowd is essential. Markets cannot function without it. Liquidity, price discovery, and momentum all depend on participation. The crowd builds trends and sustains narratives. Its failure is not incompetence, but inevitability. Collective behavior cannot anticipate its own reversal. It can only react to it. Every collapse leaves behind the same lesson, briefly remembered and quickly forgotten. The crowd enters when conviction feels safe and exits when fear feels unbearable. Value emerges when conviction is absent and fear is exhausted. This pattern persists not because markets are inefficient, but because humans are consistent. Those who survive across cycles do not attempt to outsmart the crowd in every move. They structure their exposure to avoid dependency on its timing. They accept underperformance during enthusiasm to avoid destruction during panic. They understand that being early feels wrong and being late feels right until consequences arrive. The crowd will always be late because certainty always arrives after opportunity. Markets reward those who act without applause and punish those who wait for agreement. This is not a call to contrarianism for its own sake. It is a recognition of sequence. Agreement follows price. It does not precede it. When the next cycle unfolds, new narratives will emerge. New technologies will promise transformation. New metrics will claim to redefine value. Participation will build gradually, then suddenly. And once again, the crowd will arrive at the moment when risk is highest and flexibility lowest. The principles remain unchanged. Liquidity preserves agency. Debt amplifies outcomes. Real value outlives nominal claims. Diversification prevents extinction. And the crowd, reliable in its consistency, arrives last. Those who understand this do not seek to escape cycles. They seek to endure them. Crises do not destroy the system. They expose who misunderstood it. Liquidity decides who can move. Debt decides who is trapped. Value decides what remains. Diversification decides who disappears. And the crowd decides who arrives too late. These principles are not strategies for profit. They are strategies for survival. You will not hear them promoted during booms. You will only hear them whispered after losses. If this changed how you see markets, stay here. The next collapse will not announce itself, but the rules will be the same. History does not repeat headlines. It repeats behavior. And now, you know where it leads.